I'm Todor from LAUNCHub, and I'll try to moderate this panel. And I'm quite happy actually to welcome Mina, who is with Dawn Capital in London, and Michael, who is with SpeedInvest. So with Michael, we know each other for actually quite a long now. I recently realized it's almost 8 years. We have done a couple of deals together, and we are quite happy to be in constant contact. And with Mina, we know each other for a year or so. It was totally a cold contact because we realized that there is a Bulgarian in Dawn already, and we are also happy that we have done a deal together with Dawn quite recently. But I would ask you to introduce yourself, most probably starting with Mina, just to share a few words about you, your background, and Dawn Capital, of course.
Sure. Thank you for having me. So my name is Mina, originally from Bulgaria. So, you know, the Bulgarian mafia is strong in London. So I grew up in Bulgaria, and then I moved to the UK actually about 17 years ago. Very long story, but ended up having a career first in management consulting and then in investing. So I started my investing career in growth private equity originally about 5 years ago now, and then about a year ago joined Dawn to do early stage tech investing. I particularly really wanted to focus on B2B tech, and Dawn Capital is the biggest early stage B2B tech investor in Europe. We manage about $500 million across 3 different funds. We invest in Series A and B across Europe, and we only focus on B2B technology. I particularly spend a lot of time on fintech and future of work topics, and I also spend a lot of time covering Nordics and Eastern Europe increasingly. So my last deal, actually, Todor mentioned we should talk about our last deal. So my personal last deal was actually closed in March. So we closed it. We actually did a due diligence and underwrote it in January and February, but the actual closing happened in March, and that was a LAUNCHub deal. So we invested in a company called Clean Shelf, which is very exciting entrepreneur from Slovenia who has his entire sort of development and product team based there, and then the commercial operations are in San Francisco. So it's a super exciting company that actually does something that I think everyone's doing these days. It's a platform that helps you stay on top of your SaaS software spend. So they've been doing actually very well in these last few months. So that's a bit about me and Dawn.
Thank you, Mina. Michael, what about you? So the people, I suppose, know you because you're quite often in Sofia, but still.
Yeah, I hope so. But let's give a bit of a background. So Michael from SpeedInvest, I'm one of the founding partners. We actually started this 9 years ago as a small, very regional fund, and just recently closed our latest main fund, which is a 200 million euro seed stage fund where we invest across Europe. So we have deals from, I think Bulgaria is probably the first east we came to. No, actually we have a Ukrainian deal as well. So very far east to UK, and from Estonia to Turkey. We've got deals also a bit outside of Europe. You know, there's this 10% allocation for deals in the US. We also have a deal in Bangladesh, just recently a fintech deal. So pretty broad in terms of geography, also broad in terms of sectors. So we do a lot in fintech. That's probably what we're well known for, but we also do a lot in enterprise B2B, where we actually have 2 co-investments with Dawn, Bitmovin and Crate. I personally have spent some time in e-commerce and consumer as well. And we just recently, like 2 years ago, launched a marketplace fund and an industry fund. So also in terms of industry is pretty broad. Also very uncommon for a VC. We're now almost 70 people in the fund, which typically raises some eyebrows with fellow VC colleagues. Like, how do you feed all these hungry people? But that's a very particular thing because we operate a platform. So 20 people that will help you grow your startup very operationally. And then on the other hand, we have these 5 investment teams that are really trying to be experts, in their respective fields. So every area is covered by a team actually. And so I think the support level that we can provide far exceeds what a lot of other funds will do. At least that's what we're trying to do. Also, we have a quite sizable portfolio of, I think, 140 portfolio companies right now. And yeah, very excited to be in the conference. Also, I hope I can go to Bulgaria soon again. Looking forward to that, not only because of the temperatures, but also because we've got some very exciting investments in Bulgaria, and I hope to do more.
And what is your last investment for the last couple of months that you can share? Just a few words about it.
Yeah, so the last investment that we closed, actually, I think so. We did 4 investments since Corona started, which were sourced and negotiated and closed after the 15th of March. And one of the last ones is actually just in closing. It's a company that enables you to take 3D models and put them into any background that you want, manipulating that background and creating 3D images, basically, in kind of like a photo studio. So think of a Canva for 3D image photos. We're very excited about that one. It's not yet announced, so I can't say the name, but yeah.
Okay, thank you. So just before starting with the different questions that are related to fundraising in those times by startups, to wrap up how we see the situation. So currently we have most probably unprecedented times. So we have, from one perspective, the pandemic, the total disruption in supply and demand markets, and the movement of people and capital to a certain extent. And this combined with the unprecedented oil pricing and unprecedented printing of money of the governments that already started in our opinion. And actually the early data shows that in terms of the VC industry and the funding stages, this has affected the most actually the early stage rounds, seed and Series A. Most probably there is a certain explanation about this because those are more early stage companies. You need more meetings with founders and understanding of the team dynamics. So in this environment, what even on the short term have changed for your companies initially? So how do you perceive the situation, and what are the immediate steps in terms of investment pace, in terms of decision making that you see happening in your companies?
Start or?
Yeah, please. Please.
All right. So in terms of investment, let's see. I think there was a moment, probably 4 to 6 weeks ago now, where this was really a very uncertain situation. So I think the very first instinct for all of us was to look in our own portfolios and just secure what was there, figure out who has cash, who doesn't have cash, how are people doing, what's the immediate steps to secure that. So I think it's fair to say, whoever was saying they're open for business like 2 months ago, I don't know, maybe they were, but I can kind of bet that, all eyes were on the existing portfolio. And obviously, we have our responsibilities to our founders and to our LPs to first look after them, right? So that's what we were doing. And I think that was definitely the right thing to do. And that was the sort of thing that was taking up all of our time. I was talking to my companies basically every day for a few weeks, which I think pretty much everyone was doing. So that's kind of behind us now. And I think that moment we have the plans now, we have the new projections, we figured out the cash situations in most of our own companies. And then what are we doing in investing? I think we are open for business. We did sign, not as many as SpeedInvest, but we did sign a deal, completely remote sourced, due diligence and closed. It's actually funding, I believe, in 10 days from now. So that's happening. Having said that, it's not easy. We've been trying to figure out how do we build the rapport, how do we gain the trust of the entrepreneur, how do we get to trust them remotely. Like a very big part of what we would do is, we would go spend a couple of days with the company, just meet everyone, get the buzz of the office, really try to understand how people tick, especially at this early stage, is very important to understand the team dynamic, not just sort of the product and the market and all that good, cold, factual stuff. So that's been a challenge, but that can be overcome. I do think it's fair to say pre-existing relationships come to count for a lot here. The deal that I did was with LAUNCHub. The deal that we've just done, we had also a very reputable investor leading the seed round, an investor that we trust very, very much. And so we had that sort of level of trust there and recognition. And so I would say what I'm seeing is that, first of all, supply of new companies raising is definitely less. I think you're raising if you're doing really well, and then it's kind of business as usual. Maybe you take a bit longer, just like logistically it's tougher to get people comfortable or on the same page, so you have a little more time to look at things. And then if you're raising from a position of weakness, it's not pretty, I would say, in early stage. So I would say, I think everyone who is raising now either is showing great metrics, and can pretty much have more or less a similar experience to what was before, maybe longer time, maybe slightly more conversations. And then if you're really in trouble, that's tough.
So the internal rounds that you're trying to do most probably.
Yeah, mostly we're trying to, if there is ever, I mean, luckily our portfolio is sort of pretty okay, but I was thinking, what would I advise a company right now if it was one of mine? And I would say, either, we really believe in you guys, so we're just gonna do an internal round, or, we don't really, and then trying to raise from external investors. It's very tough.
Michael, what about you? How this affected your decision-making process in general, in short term? How do you manage this building of trust, this due diligence type of initial steps with founders?
I mean, I'd say it hasn't affected it much. I mean, we did the same thing as Mina mentioned. We usually would fly the founding team here for a workshop, spend half a day and try to get, the read of the room. And that obviously is not possible. In one of the last term sheets that we actually signed, we put in what we call the walk in the park clause, where the founders had to take a walk in a park with one of our partners to, substitute for that being in the room together. And that was a condition for closing the transaction. But I think
it's part of the term sheet, frankly.
we're writing a blog post about it. So I think that's, what you can do. I mean, we were doing deals remotely before, especially if we did like a US deal or something, we wouldn't go there. We just trust, the judgment of the partner that would do the deal. But basically, I think we have to get, comfortable with that new reality. I mean, I'm seeing it in our office. I think we're going to look at much more remote work going forward. People are getting used to it. So I think that's something we have to get comfortable with and adapt to it. I wouldn't say that it has changed our decision-making so much. We've seen the same number of deals. We've actually pursued the same number of deals. Of course, after this initial 2-3 weeks, where basically I think I had 17 board meetings in 10 days. So, all of a sudden activity compounds. But we're back to where we were, I think, before, trying to make sense of that, and also we're not going to do any personal meetings with founders until at least end of May, probably end of June. So that's a new reality that we have to face.
Does it mean that, given the fact that you have been doing deals remotely also before, does it mean that in those deals and even now you're more often checking references and client call, and also people that you want to touch base about the founders more than before currently?
I wouldn't say so. Maybe that's something that will happen, but I think what happened is really, so the current situation, I guess, made us more cautious in terms of business model rather than in terms of founders. So I think, if you're in the same room, of course, you get more signals, and that's more difficult around Zoom, but it's still, I think that's a call we can do. What I've seen us shy away from is those deals that you would probably do, last year, this time, you would probably do them that require a lot of capital, that, they're built for growth, they're built for a boom market, which of course, everyone was expecting it, that, the market would sort of have a correction. Nobody expected this type of correction and that severity, right? But it's quite clear that a lot of the models that we've been looking at a year ago wouldn't fly today, and would probably reject them right away.
And so starting from there, how this affects actually how much you put away? So the business model is one, but also to traction nowadays, because seed and Series A being quite different, of course. Is it more important nowadays for the company to show traction in all type of respects, or do you see both of you more looking at numbers nowadays?
That's interesting, because Mina, I'd love your perspective, because you're typically coming in probably one round later than we do. And it's a big debate that we're having internally. So there's a lot of people saying that we need to look at traction much more. And then I look at the deals that we're doing, and they have the same amount of traction. Like, we just did a digital health deal that is basically still in product development, and they're not going to launch until end of the year.
Yeah.
So I'm not seeing it, even though everyone says they're looking at more.
Okay.
Yeah, no, that's very fair. I think for us, we also done where I think our DNA is we've always been extremely metrics driven first. Like, we would sort of, like, the metrics have to check out for us to even go and do all the other stuff around, market and trust of the founder. So I think that's not really changed. I guess the question is, do you then cut people slack because of, what's going on? And I think, we are growth investors. Every company that we invest in, we think it can be a unicorn, and we think it can return our entire fund. Like, that's the underwriting threshold for every one of our companies. And that's always been the case, kind of regardless of the situation. So I can maybe speak to, I guess, the deal that we did right now. And I have to say, this is a deal that had a lot of traction, and they were continuing to add good amounts of new business throughout even the months of March. Did we expect them to be hitting their budget? Not necessarily, but we definitely spent a lot of time figuring out, okay, how is their pipeline doing? We spent a lot of time talking to their existing customers and figuring out if they have room to upsell, because I think what's happening right now is, like, landing new business is very tough. A lot of companies are just not taking on new vendors. It's kind of, people have either completely stopped spending or only doing, like, very essential things. And so unless you're like Zoom or Hopin, perhaps, then you can, it's a tough ride. But we were spending a lot of time figuring out, can they actually upsell their existing customers? Is the product, like, strong enough and solving enough issues to do that? So we definitely look at I guess traction perhaps in a different way, recognizing that, perhaps, top of the pipeline may slow down, but you still need to show an ability to continue delivering some growth, especially at this early stage, because, if you're so early, maybe you kind of get over it and you return to growth, but it's just so hard to tell. And I don't know if we are ready to make that call yet, unless, your product is absolutely super strategic and the tech is so differentiated that we know that, the strategic value is just so strong and people will come back to you. It's important to show that you're still adding business.
But does it mean, Mina, that so if there is a, let's say, traction that, so comparing with, let's say, 2 or a couple of months ago, most probably you are looking more deeper at traction. Can somebody mitigate this with other aspects of the company? Because most probably in lots of companies currently it's very difficult to build substantial month-on-month growth, of course, if you are not on the side of those that are profiting from the situation.
Yeah, like I said, I think, how would I think about it? I think a very strong team and really differentiated product always helps. Like, that's always the case, right? I mean, that's not new news. But I suppose if you're gonna sort of compensate for something, if you're just another Me Too product, or there's not a very clear sort of competitive differentiation, it will be tough, because so I think that's one way to differentiate. Just really demonstrate from your existing customers that you are, absolutely critical to them, or what your product does is better than anybody else. And then the thing is, it's tough for me to comment because, we are investors in B2B SaaS. So all of our companies that we look at have pretty solid unit economics. I think if you've been looking, to Michael's point, if you've been looking at different business models before, certain business models right now are preferred to others. But for us, we've always invested in SaaS companies. So we always have seen sort of, very high gross margins. Typically, we like companies that have not too long payback periods and so on. So I think people are paying a lot more attention to this. But for us at Dawn, that's been sort of bread and butter historically. So that hasn't really changed so much. I think if you are more on the B2C side or different type of business model, perhaps showing stronger unit economics is always better, obviously, in these times.
And Michael, how this changed for you? So you said that you're still active in kind of revenue, even pre-product sometimes, I suppose. So what are the things that are exciting for you to do such a deal under the current circumstances?
I mean, of course, it's a factor, or what factors in is the industry. I mean, the deal that I just mentioned was a digital health deal, so those, of course, are very good off right now. I'm not sure you would do a travel deal that is pre-product or pre-revenue at the moment, as Mina said. But in the end, I think for the early stages, not a lot has changed in terms of team and product and what you look at, as Mina said. So the only thing that you're looking at is that a business that can get to meaningful unit economics anytime soon. I mean, we've looked, for example, at a marketplace for medium-term stays. That's of course in an economy where you're not sure what's going to happen to real estate, to travel. You don't know if the unit economics can work in that environment. You'll need a lot of cash, and as an early stage investor, of course, you're kind of dependent on looking at the later stages and figuring out, will they invest in such a business? And then of course that's like reading. You just have to take a call at some point, and I think that's what changed, that we're not comfortable taking those risks at the moment.
How about valuation? So it is very strange from my perspective, because like VCs, we always preach that private deals are affected by the public markets. Kind of, at least everybody is looking at multiples of different industries or verticals. And everybody is expecting that currently the private valuations are going down, but actually on the public markets, the valuations are going down, especially in some certain sectors. So how you look at this going forward from your perspective? Michael, so in those early stage deals, have you started applying different valuation approaches, or you're still on track with the previous world?
So I think we all hoped that after sort of the level of valuations that we were seeing in the last months, that they would come down to a sensible level. I mean, just I mean, when we started, we usually invested, I don't know, 250 to 500,000 euros at an average valuation of 1.5 million pre. Now we're investing 1.5 million at an average valuation of 6 pre, or 6.5 pre. So it's just, you know, the level in those 9 years that we've been doing, it has increased dramatically. Honestly, we've not seen come that down at all. I've not seen a single deal being cheaper than before. In fact, I think the really great founders, serial founders that are in sectors that are considered hot right now, they can even raise it at higher valuations. So I'm not seeing that happen. We're also not seeing that happen. So finally, a couple of follow-on rounds have happened in our portfolio since Corona broke out, and we're also not seeing any valuation discounts there yet from the later stage investors. What we've seen, and I think that's much more what happens right now, is that some rounds fell apart. So, you know, if there were some investors backing out, even if they had a term sheet signed already, and we saw that it was much more a binary decision than, you know, let's just renegotiate that deal and get a better deal, because it was fundamentally, if they wouldn't believe in the company or the market, or, you know, the risk was too high, then they would back out. But I'm personally thinking that we will see valuation, especially in the latest stages, come down. So I think a lot of the lofty valuations that we've seen, they will not happen at least for the next 12 to 18 months. I'm expecting them to get back after that, because also there's so much money in the market, and that money hasn't gone anywhere, right? So we haven't had, I think we had one LP withdraw his commitment that was a private LP, but we've not seen a great exodus of LP money. So the funds are all still afloat with capital, and they all need to spend it in a way.
And what about you, Mina, later? Changes in the valuations or not yet?
So I think, yeah, very much echo what Michael is saying. We had a follow-on round. We had a follow-on round into one of our Series A companies, so a B round, and that came at basically the same valuation we were expecting before, and that got done. That's also still to fund in the next couple of days, but that got signed 3 weeks ago, I think. So that was fine. In terms of new things, very similar observation. I think valuations are staying healthy. Indeed, good founders, strong founders with, you know, strong product and kind of good traction, like we talked before. Everyone's needs to spend the money, and there is definitely flight to quality. So what you don't see is sort of people going and doing these crazy things that we used to see a few months ago, like especially in Series B and C, you used to kind of have a few investors would just come in and sweep in with a valuation sort of 70% sometimes above what the sort of market consensus was. And I've not seen that happen yet, but that's not to say that it won't, because honestly, like, people indeed have tons of money and they need to deploy that. And like you said, public markets are holding, so LPs are a little bit, normally LPs start to get really nervous when their equities are like, their equities out, and they don't want to lock in losses to like fund, you know, illiquid investments, but that's not happened. So somehow, in a very strange way, kind of same old, What I do hope to see is that indeed this kind of crazy thing of coming in at a massively inflated valuation tends to go away a little bit. But we'll see. So far, indeed, things are holding up. And if something is not really happening or there's no traction in the fundraising, yeah, typically it would just fall apart. Or frankly, what we have seen is people starting to try on some of these more like aggressive structuring things.
This is what I was about to ask you, actually. Do you see those? So the usual frame of the VCs was that all of us were founders friendly. So this is part of the communication, and most of the people are trying to be. But in terms of conditions in term sheets, do you have started seeing actually more strange and non-market behavior already?
I've seen it a couple of times. I want to say here, and I mean, look, this is sort of personal view and also maybe Don's view, but I think because we are so early stage, investors who sort of really understand the game, I think they understand that like having some sort of structuring or downside protection at Series A is like, it's just not serious, right? Like, what downside protection do you really have? Either you believe in the company and you're underwriting a winner, or you don't, right? So I just, like, we are very much sort of allergic to that kind of thing, and we would also advise all our companies not to take that kind of term sheet just because the relationship is just not what you want. Having said that, you know, you have all kinds of investors out there, and I do think it's sort of early, like later stage, perhaps Series C, D, and E for certain deals. It might make sense to actually have a little more structuring in the rounds, and then it also depends sort of where you are as a company and how you think about that, and if you really need the money, what's your situation, and you know, at later stage maybe it's not such a horrible thing. I think for early stage, I would very cautious with that, because then also your follow-on investors have to come in, right? And I think if they see kind of funny things going on in the cap table and strange dilution to the founders and things that are just generally against founder interest, it's very tough later on to have those discussions with follow-on investors as well.
Michael, do you see such things already with your companies?
Yeah, but we typically see them not with new investors coming in, but with existing investors structuring follow-on rounds. So what you now see in that situation very typically is that, you know, existing investors chip in money, but they want some kind of kicker, 2x, 3x liquidation preference in some cases. So yeah, it's just, you know, when the power shifts, that's what typically happens. And as a founder, you can just hope that you'll never get into that situation that this kicks in.
But what would you recommend to the founders? So if because sometimes they just have to fund their companies. This is the role of the CEO apart from hiring at the end of the day. So being in a situation that they accept such type of terms, do they risk about the follow-on investor guys like you to somehow judge the ability of those founders to negotiate? Does this kind of plays them tricks on the valuation of the team and the founders' capabilities of the later stage investor, or you can realize or accept that this is part of the game?
So I wouldn't say so. I mean, you know, there's the saying that luck is where opportunity meets preparation, and I think bad luck is where you weren't prepared for sort of what happened in a way. I mean, I found it interesting that in the description of the event, you were using this this statement that, you know, crisis in Chinese is the word for opportunity, and something else, whether that's a mistranslation, it's actually danger at a point of junction. And that's exactly what happens here, right? It is a point of junction. Either you continue to run your business or you go down, and there's no other option. And if you don't have any option left to fund your business, then what else should you do? And everybody knows that. It's really, for some companies, it's sort of, it's some companies are hit twice. First, because maybe their business is more affected and they just have, to figure out how to get out of this. And then they were just preparing a fundraising round, or, they don't have a lot of runway left. And then you're really at the mercy of people giving you money, and there's not much option to negotiate. And my feeling is always startups are an options game. You always need one more option left than you intend to use. And there are situations like these where there are just no options left. I mean, even if there's government programs, if you look at sort of some of the later stage startups, anything that they can get out of that will just be a drop in the ocean of what they actually need. So I wouldn't say it's a judgment of their ability to negotiate. It's just a matter of fact. And as a founder, I always would say, I would tell them, look, just that's the reality. There's nothing you can do about it. You just deal with it and go on with it, and try to do what you can out of that situation. Of course, personally, it breaks my heart to see that happen to people who've poured all their life for years into that startup, and then you're losing 2 years or 3 years or even more, right? Because you're pushed back to that point in time where you actually thought you're past that point already, and then you figure out, so.
Yeah.
No, yeah, absolutely. I think it's very depend. I actually was looking at the bridge round of a company that I think is really great, but for many reasons they've kind of really been hit twice, like you say, Michael, by this situation. And we didn't end up investing in the bridge round for a number of reasons, mostly because we are not that kind of investor, so we couldn't find it in ourselves to get comfortable with some of the macro risks. But that aside, like if I think of that company, there's absolutely, if they actually get out of this and I had an opportunity to go in and go at a much higher valuation in their next round, I would happily do it, right? Provided that their follow-on DD checks out. So it's really, like you say, your responsibility is to keep going for your company, and depends on the situation. If it's very clear when you had no other option that you just have to keep going. So that's that. And the other thing is, this is the startup business, right? So this is entrepreneurship. Like, we know that a lot of companies will just not make it regardless of Corona or whatnot. And so that's fine. That's the game we're in. But I think we are quite sensitive to what people are going through. And I think, yeah, it's just the strength of the product and the team in the end that counts. So if you had to do something, we can live with it. So it's not a call on that at all.
I have a more general question. So our ecosystem, Southeast Europe, is kind of a smaller one. So for the last couple of years, we have been seeing actually a lot of great companies coming from different regions. So it's not only Silicon Valley or London or Vienna or Berlin. There are more and more cases that a great company can come from anywhere. Do you believe that the current environment, especially based on this pandemic, can change a little bit those things? Is it going to make more difficult the creation of great companies in more isolated places that are a little bit more away from the main clients and the main markets? Or when the environment is digitalized, it's going to make it kind of easier for more entrants from different places to be faster? What is your current opinion on this?
It's a tough
because we would like we would like to think that the let's say this stress digitalization of everything, conferences, meetings. So I'm pretty happy that nowadays nobody is actually rejecting online meetings. Like there were a lot of people before doing this. So this fast digitalization should be working in a way that actually you can be anywhere in reality to build a company.
Look, I mean, I guess, actually, I'm thinking about it, and I guess that's kind of up to the entrepreneurs, right? I mean, they are the ones that have to feel comfortable and still feel like, yes, we're going to start a great company and we have this great idea and we'll go for it. It's about the risk appetite of the people in the ecosystem. And, you know, the money is there. Michael and I are doing, we've all raised a lot of money. The talent is there. It's not like people stopped knowing how to code or how to, you know, think about product development. It is true that the end market is getting tougher. I do think that, you know, I mean, we know like software spend will go down in certain categories. Again, I'm talking here B2B software alone. So that's kind of, you know, a special view. So there will be some demand side kind of that will be trickier for some time. But you know, if you have a strong team and if you have the risk appetite, I think the money will be there. And it's just about like, do you guys feel confident to go for it and create great companies that we can back? I don't think the ecosystem will all of a sudden disappear because of this. Hopefully not.
What about you, Michael? So what is?
Yeah, I mean that's you know, it's a topic that I could talk hours about, and maybe further the sense of discussion. You know, let me disagree here, because I think just looking at the numbers, you know, where does the funding go? And the funding predominantly goes into companies that are in the big cities. And my feeling is that with VCs not being able to travel, risk profiles changing, that, you know, the natural behavior of any investor is to sort of stick to the known instead of venturing to the unknown. It's very, like, we're very rational and predictable animals, us investors, I'd say. So it's much more likely that you do a high risk deal in London than doing a low risk deal in Sofia in one of these environments, right? So because, you know, there's tons of reasons, the network and the social validity of the investment. And, you know, you really have to be, I mean, we're all priding ourselves to be contrarian now and then, but to be, funnily enough, being in an off geography is never considered contrarian. It's super contrarian if it's successful, right? So if you backed UiPath, then you're the great contrarian thinker, but who would go to Romania to meet the company? Like, honestly, that's and that will not change. I think the crisis will tighten that a bit, but it will not change it in general. I think, and I would probably like to shed a light on something different. I think what happens in that crisis, and we haven't looked at that so far, is that that there's a lot of talent becoming available also in the startup ecosystem. Like if you look at, you know, the announcement by Uber, Lime, you know, you name it, a lot of startup companies, they're setting free thousands of employees. Airbnb, I mean, and those are just the big names. So you'll have to see that in the big cities, there's all of a sudden that amount of great talent becoming available that other startups can hire to their advantage, and that will by themselves also create new companies. Because if you've been part of Airbnb, you know, you have two choices: either you go work for some other venture-backed company, or you do your own startup. And I think in 10 years, we'll look back and we'll say, this was the inflection point where we actually saw a lot of new founding activity. And where does that founding activity happen? Of course, it happens in the cities where those people were working, and those are the big, you know, startup ecosystems. That's just natural. Of course, a lot of those companies will be remote first. They will be designed remotely. But still, it will be a Berlin or London company if those people are living there, and they'll not change their home just because of COVID.
So from that perspective, what would you advise the founders of a company that, let's say, perceive they need to start fundraising in the next 6 to 12 months? So intuitively, they will talk to VCs that they have already met. 2 months ago, personally, they have some kind of communication. How they should approach people like you that they haven't met before? How early is it going to take more time to understand better the company, more interactions with the founders? What would you be your advice in that direction?
Start this time. I think it's going to be much more interesting or much more difficult to build some kind of rapport, like Mina said. So I definitely think that every investor now in the next months, also there's summer coming, that a lot of investors will just slow down in their investment activity, not because they have some giant plan behind it, but because it's just what the industry does right now, right? You tend to not overspend money, to only spend it into the more less risky opportunities into your own portfolio, yada yada yada. So I only really expect that in autumn we're going to go back to sort of what it was before Corona in terms of deal volume. So if you can delay it by any means, if you can reach out already now, just trying to build a rapport early on so that you're actually already sort of at the gates in autumn, Q3, Q4, when the deal volume also naturally picks up because people tend to do more deals in the second half. So just trying to really get a conversation started. I think that happens. And at all costs, trying to figure out what's the story that you're telling. And I think the story cannot be the same as it was before Corona. There has to be a different twist on it. It has to cover some aspects. I mean, we're all definitely going to ask about how you set up your team remote. We're going to look at much more how crisis-proof is your business model. What happens if there's a second wave? All these things I think you need to have good answers to. And my feeling is also, I said, but I don't know if that will happen. My feeling is also that probably the expectation setting in terms of what we're seeing, valuation, how much ownership you want to give away, is going to be very dependent on what industry you are in and how hot your deal is, really. And calibrating those expectations probably is also something that has to happen before.
Do you think that they should be planning for a longer, let's say, runways than? So before the standard was 18 months, but with the current expectations that there are going to be few waves from the pandemic, do you think that they should be looking at longer type of months coverage?
I mean, that's the thing that I generally, it's also a long discussion, but I think in general that thinking, especially, for example, in enterprise or B2B SaaS, there is a scenario, and you always have to have that scenario in mind that you can go break even. That has to be on your list. It's probably not the scenario that you're trying to go for, but I don't know why you would build a company that cannot sustain itself at all at some point. So, I mean, the goal of this whole exercise is that at some point you don't have to fundraise, but you can fundraise and you can actually choose who you want to work with, and you can, shape the terms that you're getting. This is what you're aiming for. So I think planning for longer runway, having a plan how to go to break even, be more nimble and, more creative and inventive how to structure these things, I think will absolutely be necessary, instead of just planning that you're going to ride the venture capital wave for the next 4 years or something.
Okay. Well, what about you, Mina? What do you think?
So very similar. If I think about what I'm doing now, I'm basically building my pipeline for the second half of the year. So I'm having conversations with companies that are a little bit early still. Most of them are planning to start fundraising kind of Q3, Q4. And, in the end of the day, it's not like all powers is to the investors now. We also know that we need to be in dialogue with the most interesting companies out there early on, because just as we can't meet you and get to trust you, so can't you. So, it's important to have that dialogue going, and by no means is it just kind of investors market, although maybe the power has shifted a little bit. So for sure, having those early conversations. I think if you're reaching out to someone that you really haven't met, please just, it's kind of important to really do the due diligence and like know that this is an investor that has invested in a company like yours before, you know, just like the basic things. There's no one loves like a cold email from something that's sort of not really relevant, or they don't. So, you know, that's just kind of basic intelligence. And then I would say right now, definitely be having those conversations, but indeed, if you can delay, or if you just can kind of start building it so that you're not caught off guard and you don't have the pressure that you must close something and then maybe get into uncomfortable situations, that's the best thing to be. The second thing to say is, you know, if you're a very early stage company and you're still focusing on product and all of that, I mean, you do have control of your burn, right? It's not great to kind of go slower because maybe you have this fantastic idea and but you do have control of that. So that's kind of your toolkit for figuring out, right, you know, it's not the greatest time. Maybe I go slower on this, or, you know, whatever it is, to really control my destiny here, so I don't run out of money or have to go and give away half of my company now, because otherwise I can't keep going. So that's also important. And look, I think we're all still figuring this out, but by all means, we have to keep investing. We have the money, so we're figuring out how to make it as seamless as possible. And actually having these connections and relationships that are amplifiers is really helpful. You know, we have we investors, we rely on VC funds to help us navigate and you know, help us uncover really promising companies in the region. So you can actually plug into kind of network amplifiers that help bring others that you didn't know, but still can have this like trusted connection and a warm intro as you go out to fundraise.
So does it mean, so currently actually so we are just starting our third fund. You're also, Michael, with a new fund. You're also closing a new fund. So does it mean that you're going to try to mitigate the investment risk with actually continuously investing over time in the years, just to flatten the curve of the economy? Or you believe that because of those times when the great companies are usually born, you will try to speed up a little bit more the investing during the course of next couple of years? So which one is prevailing while discussing internally as an attitude?
You mean in terms of piling in and doing more investments now in the next couple of years?
Yes.
Yeah, so interestingly enough, the first Dawn investment that was very successful was Mimecast. That was a Series A, I believe, or Series B that we did in 2008, in August 2008. And that was, you know, one of the biggest, I think, SaaS IPOs out of Europe. So that was very helpful. So we definitely have a bias for finding good opportunities, because it is true, to Michael's point, you know, a lot of talent has been freed up, and there's plenty of seed capital. And then also people have made money, right? I mean, that's the other thing, right? You don't always need to necessarily have external investors. You can do a lot nowadays with some angels and some of your funds. So there's definitely very interesting companies that are likely to be born, and we're very excited about that. In terms of pace of investment, to be honest, you know, it's hard to think that way, because, you know, we see pretty much every relevant opportunity to us. That was a very important thing for us, to have that kind of boil the ocean thing, so that we see everything that's relevant to us, to our investment strategy. And so if we see more of that happening, we'll just invest more. It will still be similar sort of investment criteria and similar process that we follow. But we do expect that hopefully some very exciting opportunities will come our way in the next couple of years.
What about Michael? Is there a change in the pace or same?
No, we're not changing anything. I also think you just don't know what happens. So the best thing you can do is just do it like the Catholic Church. You just stick to your plan no matter what happens.
Yeah. So because we have a couple of more minutes, actually, you have already answered some of the questions. What would be your advice to let's say, founders that have already started their companies, have traction in those times? What should be the most important things that the founders should be doing now? Whatever sector they are in, what would you advise them?
Old question.
What are you telling your founders in your portfolio? What to be afraid of and what to be?
I mean, I'm telling them to not be afraid of anything, because I think that's just that's what they used to. They operate under uncertain conditions. But of course, what we try to open their minds to is what opportunities are created right now that you can piggyback on. Because I think we all know, and we all look at this, that whenever something changes, crisis is a moment of creativity. So that's where stuff happens that can carry you a long way. And there's all the examples, Alibaba was basically born under the last SARS-MERS outbreak. So, there's opportunity in this environment, and we're trying to move their minds away from the reacting to the crisis to, okay, where can I see the opportunity? What can I actually do to leverage that opportunity? And how can I come out of that crisis stronger, which is tough. I mean, we're all hardwired in these moments to really look at how to protect the downside instead of taking full risk and maybe grabbing some of the upside.
Okay.
Yeah, I would agree. I think what's interesting for me to observe in our portfolio is that, we sort of invest in these kind of scrappy founders, they are and then after a while, when you've raised a few rounds, like your burn is high, you're kind of going for it, you've geared your entire company for growth, you're like, really a growth machine, you're going into your scaling. And I have to say, for a lot of our founders and for us as well, it's a huge adjustment to make, right? You've literally, like for my companies in January and February, the biggest issue that we had, the biggest risk that we had for the company is that we couldn't hire fast enough, right? I mean, this was literally what we were talking about at the board all the time. We need this, we need that. Do you have agencies? Are you set up to deal with the admin load of hiring all these people? And then all of a sudden, you sort of yank the brakes. And it's a big adjustment for founders that are already kind of in this growth and scaling stage. And then what we've been telling them is, remember why you started your company. You were like 5 people, right? And you had this awesome product, and you had, this big problem that you were trying to solve. And frankly, right now, we don't really care if you do your 3x. What we care about is your product getting stronger. Are your existing customers keeping happier? Can you upsell them? Are you building the best team you could be building? Are you getting maybe some of these fantastic people that are getting freed up now to make you stronger? And so, that's kind of what we've been telling them, just to kind of think about, okay, in this period of uncertainty, how do you emerge stronger? And are you actually making your product and your company more valuable? And that's not necessarily through breakneck growth right now, because it's just not available for a lot of our companies, let's face it. So like, how do you take the opportunity, but also, if you, hopefully whatever you were doing before is still valid now, and you can just strengthen your product and your customer base as you go through this period.
So we have to finish, unfortunately. Many thanks for the time and for sharing what you are seeing from different parts of Europe. And we'll definitely send you additional questions if they're unanswered. But thanks again for sharing with the local ecosystem, and we'll see each other again, hopefully.
Yeah,
in person.
hopefully very
So
soon.
this is one of the things that we miss a lot, actually.
Thanks
Bye
for
for
having
now.
us.
Thank you.
And thank you, everybody, for
Thank you. Bye.
participating.
Bye.